is I just look at it and tell people, guess what, brother? Price is just going to go up or down. It's like you don't know what's going to happen. Your reasoning, your logic, you're like the banks and the interest rates and institutions, and Trump's going to get elected, and that's going to strengthen the US dollar, so it's going to go up. All this is just bullshit, and it's just a narrative and it's a story people tell themselves. All that's actually going to happen is that price is in fact going to go up or down. So I don't even play the game of trying to give all the reasoning and like this is why I believe that it will happen. I'm just like, look, it's gone really far in one direction. Forex is a mean reverting market. It's likely to have a pullback at some point. So I'm going to keep DCAing in. Anybody else who's like, that's too risky, there's this and that, I've already accepted the risk. The account is the risk. And so I don't put more into the account than I can afford to lose and that I'm willing to put on the line in the attempt to grow it, which is why everyone else who's trading DCA should also do the same thing. And what you'll realize,
they've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate the potential is by understanding that trading is not about being right or wrong. It's a probability game. Right. If you're trading technically. Now, I don't. Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade by trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal, from my methodology, at the very fundamental, most fundamental level, what this is telling me,
right,
is that
fresh cross.
I have. There's a higher there's a high, or let's say, the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means.
Right.
The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold. That's all it's saying. Price movement is always the result of an imbalance. Because when there's balance, there's no movement.
Right.
It's that simple.
Right.
If there's balance, there's no movement. Prices do not move when there's balance. I'll do the analogy to technical analysis to flipping a coin, okay? That if you take an evenly weighted coin and flip it 1,000 times, you've got a large sample size there, right? The pattern that will emerge with each 1,000 flip sample size is a relatively even distribution between heads and tails. Maybe not quite 50-50, but let's say 49.2 and 49.8 or something, whatever. There might be a little bit of more variance there. But in any case, that will be a pattern. See, that's a pattern. Because it'll happen every single time you flip the coin 1,000 times. This is exactly the way technical analysis works. Exactly. If separated, or then you can do this exercise. If you haven't, then you're going to have to do that first. You're going to have to plan your trades. In other words, you're going to have to take your methodology and determine a given set of rigid variables, because what we're going to do is set up a trading exercise with just a simple 25 trade or 20 trade sample size. In other words, what you're going to say is that I am willing to invest in the development of these skills, the skill of learning to trade without fear, learning to think in probabilities. Because when you learn to think in probabilities, the fear will go away. What I mean by wiggle room is that the variables, the criteria that you use are absolutely rigid, black and white. They're either present or they are not. That's the only decision you have to make. You are committing yourself to taking the next 20 trades of the occurrence of your edge. You will know in advance, based on testing and paper trading, exactly the optimum amount that you have to risk. In other words, what your risk is on each trade. And it's not going to be a varied amount. It's going to be a specific amount, whether it's in terms of dollars or distance. It will be a specific amount so that you know exactly how much each trade is going to potentially could cost you. And it should really be set up as a rigid profit potential too. In other words, I don't want you making subjective decisions as to about how far you're going to let the market go in your favor. Okay? And then you fixed all these variables, and so you say to yourself, I'm going to take the next 20 trades. Not just the next one, but the next 20, no matter what. You have to be prepared to take 20 losses in a row. The likelihood of that happening is about as remote as getting 20 wins in a row. But the point is that the dollar value of the risk of each trade multiplied by 20, you have to be able to afford. Put the trade on and see what happens. And if it turns out to be a winner, you think, oh, hey, yeah, Mark Douglas, hey, good, hey, this is all right, okay? Yeah. So this one turns out to be a winner, and maybe this one turns out to be a winner. And maybe, well, this one's a loser. You think, okay, I can handle that. And this one's a loser? Uh-oh, and this one's a loser. Now we've got 3 losers in a row. I have rarely met a trader who doesn't have a problem with the next trade after 3 losers in a row. You made the commitment to take every single trade. When the next one comes up and your mind is screaming, no, it's a loser. Remember how our minds are wired to think? Our minds are wired to think that way, but that is not the truth. The truth is your methodology, the mathematical formula, does not know what the outcome of that trade is going to be, and neither do you. If the standard amount of shares that you trade would say that, if I lost 20 trades in a row based on how much I've got to risk, it's going to be $5,000, you say to yourself, you know what, I don't want to spend $5,000 on this, then don't. But say, I'm truly willing to spend, let's say, $1,000, then set it up where the amount of contracts or shares that you trade correspond to adding each one up where it comes up to $1,000. It'll be amazing. Do the exercise. So does anybody else have any questions about how to set this exercise up? How long are you going to do the exercise? If you set it up and do it, how long are you going to do it? What's the criteria? That's right. Till there's no conflicting and competing thoughts. Until you can do it flawlessly. Until you can do it. Until it's like just a part of who you are. It wouldn't occur to you not to do anything other than what your rules say. It just wouldn't even occur to you. It doesn't even enter your brain. And I guarantee you, at that point, you will be thinking in probabilities. The most successful traders love the process of trading, whereas a typical trader usually ignores the process because he's obsessively focused on the outcome.
Quantitative investing, we're using systematic processes to ultimately take the decision-making or emotion out of the process. And so rather than relying on human decision-making or human emotions to dictate the process, we're allowing the science to actually make decisions for us. And so oftentimes we hear about people who are running discretionary strategies who make not necessarily always the best decisions because they've allowed their emotion to get to them. And so by deploying quantitative strategies, you
have to have a passion about the process. And I know people hear this all the time. And they go, oh, it's a cliche. The process. I hear all about the process. You know why you hear about the process? Because it's the most important thing. Yeah. If you are not fascinated about the process, then go find somewhere else to go. Because trading isn't for you. Okay, well, actually expand on that because I agree with you. Yeah. I think you should never look at a single trade as your defining moment.
I think one trade can break you, definitely.
Oh, it could.
Yeah, it can break you, but it's never gonna make you. Yeah, because if it's all due from luck, it's not repeatable. You're not gonna get lucky.
Break you, you were missing out on something very important, that is risk management.
Yeah, for sure.
No trade should be able to break you, but if you don't manage your risk, guess what? The market's like the ocean. Yeah. It doesn't care how big your boat is.
Yeah, it's like
being less random trying to focus on data. So where do you have an actual edge? Getting away from trading emotionally, which is basically trading for money.
What do you think of the year 2022 and what?
I would say be patient with yourself. Understand, like I said, 3-4 years. You really have to commit yourself to it. It's not something to half-ass. I would say that you need to put your full energy into this, and it will pay out appropriately, depending on if you really treat this like a business. And
I'll give 2. 1, don't give up. And 2, risk management. That's number 1. That's the only thing that'll keep you in the game. As long as you survive for the next round, that's all that matters.
How has trading transformed your life? What was your life before and now after?
It's shown me who I am, basically. Like, a lot of stuff I didn't know about myself that trading brought out. So like, how I deal with stress, pain, that kind of stuff. So it kind of like made me look in the mirror and deal with what I have. But that's basically how trading's like affected my life.
A lot of things that I cannot do, that's why I'm trading.
What advice would you give to fellow traders watching this video?
Well, first, to start slow and don't pursue the money, pursue the process. I think that's the best thing. And start small. Like you don't have to go big at the first year and a half, maybe. So start small.
How has trading changed your life? Would you give to our fellow traders watching this?
That's an easy one. Learn how to lose. If you can lose, you'll be okay. If you can't lose, just give up and put the money in my pocket right now. Peace.
What kind of advice would you give to our fellow traders watching this video?
Risk management. Know when to cut. We all make mistakes. But remember that you can always trade another day.
Wise words. Risk management, everyone. Remember this. How has trading changed your life?
I make more in my trading than I do in my medical practice.
When they put on that individual trade, often become traders, when they put on that one individual trade, often become obsessed with that one individual trade and trying to make that one individual trade profitable. It's super important for traders to not have a random approach to risk management. I cut my losers at 5%, or I do this at this percent. We're not trying to trade today, tomorrow, this week, the next 6 months, the next year. Ideally, this is like decades. We want to be trading for 30, 40, 50 years. Drawdown, but I called it right that time. Ideally, this is like decades. We want to be trading for 30, 40, 50 years.
Yeah.
So if you build these bad behaviors of really big portfolio drawdown, but I called it right that time, I'm good now.
It bounced back and you get saved.
And then you're good. You're like, man, I can call this. I know what's going on. And then sooner or later, risk will be realized.
Yeah.
And then you'll have that scenario where it falls down 20% again. You'll do the same thing, but instead of stopping at 20, it goes to 40. And now you have a big problem. When I was in my early 20s, I made what I called a millionaire roadmap.